Welcome to MoneySavvyPro, your ultimate guide to financial success. In today's video, we'll explore the world of mutual funds and discuss the different types you should know about. Mutual funds can be an excellent investment vehicle for growing your wealth, so let's dive right in. Segment 1. Introduction to mutual funds. Mutual funds are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of securities. They are managed by professional fund managers who make investment decisions on behalf of the investors. Mutual funds offer an opportunity to invest in a wide range of assets, such as stocks, bonds, and money market instruments. If you find this information helpful, please take a moment to hit the like button. Your support motivates us to create more valuable content like this. And don't forget to subscribe to MoneySavvyPro for more financial tips. Segment 2. Equity funds. Equity funds, also known as stock funds, primarily invest in stocks of publicly traded companies. They offer the potential for high returns, but also come with higher risk. Equity funds can focus on specific sectors, such as technology or healthcare, or they can be diversified across various industries. Segment 3. Bond funds. Bond funds invest in fixed income securities, such as government bonds, corporate bonds, and municipal bonds. These funds aim to provide investors with regular income through interest payments. Bond funds can vary in terms of risk and duration, ranging from short-term to long-term bonds. Segment 4. Money market funds. Money market funds invest in short-term, low-risk debt securities, such as treasury bills and commercial paper. They are considered relatively safe investments and aim to provide stability and liquidity. Money market funds are an excellent option for investors seeking capital preservation and easy access to their funds. Segment 5. Index funds. Index funds are designed to replicate the performance of a specific market index, such as the SEP 500. They aim to match the performance of the index rather than outperform it. Index funds offer broad market exposure and lower expense ratios and are popular for their passive investment approach. Segment 6. Balanced funds. Balanced funds, also known as asset allocation funds, invest in a mix of stocks, bonds, and sometimes cash equivalents. These funds aim to provide a balanced approach between growth and income while managing risk. Balanced funds are suitable for investors looking for a diversified portfolio within a single fund. Segment 7. Arbitrage funds. Let's explore another type of mutual fund known as arbitrage funds. Arbitrage funds aim to take advantage of price differentials in different markets or segments. These funds exploit price inefficiencies by simultaneously buying and selling securities, such as stocks or derivatives, to generate returns. The strategy behind arbitrage funds involves capitalizing on price differentials between the cash market and futures market or between different stock exchanges. By executing these arbitrage opportunities, the funds aim to generate consistent and relatively low risk returns. Allocation between equity and debt can vary based on the fund's objective and risk tolerance. Segment 8. Conclusion. Segment 8. Conclusion. And there you have it. Our guide to different types of mutual funds. Equity funds offer growth potential, bond funds provide income, money market funds focus on stability, index funds track specific market indices, and balanced funds offer a well-rounded approach. If you found the information in this video helpful, we would greatly appreciate it if you hit the like button and subscribe to MoneySavvyPro. Your support motivates us to continue creating valuable content for you. Thanks for watching, and we'll see you in the next video.